Good morning, everybody. Lee Lowell here, smartoptionseller.com. It is Saturday, August 8th, 2020. Welcome to another edition of the Saturday Synopsis. We'd like to take a look at the charts, see what happened in the market over the last week, and give some ideas on what we may see coming forward in the next week. So sit back, relax, join us for a few minutes. And we also like to give some great options information in these videos as well. So let's take a look and see what happened over the last week in the markets. We take a look at the three indexes, the S&P 500, the Dow Industrials, and the NASDAQ. We always start with the SPY, which is the tradable security for the S&P 500. Let's take a look. Let's back it out a little bit. Another strong week. Market keeps going up. Opened up on Monday and bounced off the 20-day moving average line, which is the blue line here. Always have three moving averages on the chart: 20-day, 50-day, 200-day moving average. Market looks strong, bounced right off the 20-day moving average, and it's gunning for the, let's open this up a little bit. Back here, right before the coronavirus started, we had this gap down. See this blank space on the chart? That's called a gap move, where there's no trading in the blank space. Typically, what we like to see on the charts is these gaps eventually filled at some point in the future. Finally, this past week, you can see how the up move filled in the gap right here, from the top of this bar to the bottom of this bar. Got the gap, and all of that gap has now been filled by the move up in the S&P 500. That's what happens with gap moves. You always like to see them filled. So market looks strong. S&P 500 looking good. Path of least resistance is higher. Let's take a look at the NASDAQ, which has always been the strongest of the three indexes. This keeps going. Had a gap up on Monday. So we've got a little gap here. Market is strong. The NASDAQ just keeps going up. It's been riding this 20-day moving average line, blue line right here. So if you've been wanting to get long, and you can also use the QQQ, just like the SPY, the QQQ is the trading index, or the trading ETF, I should say, for the NASDAQ. So if you've been wanting to get long, it's been a great system to just buy when it bounces off the 20-day moving average line. Look at that. Perfect. Perfect way to buy. Market looks strong. I mean, keeps going up, right? You know, you only get a little bit of a chance to get in. These little pullbacks, you got to buy when it bounces off the 20-day moving average. So NASDAQ looks strong, S&P 500 looks strong. Let's take a look at the Dow, because that's been the weakest of the three. Dow Industrials, we talked last week, just last week, last Saturday, how the Dow was having trouble getting through the 200-day moving average, which is a huge deal to people that like to look at charts like myself. Finally, this past week, it jumped up, had a nice move up, just like the S&P 500 and NASDAQ. The Dow had a good, strong rally this week. It is now above the 50, 20, and 200-day moving average. Looks strong. Still has a little ways to go to getting back up to its highs that we hit back in February. There's this gap right here as well, so we want to see that close. But just like the S&P 500 and the NASDAQ, I can only see the Dow Industrials going higher. Is there any news on the news front? Well, here in the U.S., the coronavirus is still rising, unfortunately. We need to do a better job of getting people to wear masks and socially distance. But to temper that, we're also, the U.S. government's also trying to pass another stimulus package to offer businesses and individuals more money in their pockets to keep them afloat while the unemployment is still on the high side. So we're trying to help people get through those tough months. So that's holding the market up. The market is always looking forward to better days ahead. And so the market likes that. And things are just going higher. You got to go with the path of least resistance. Right. And so in addition to the U.S. government putting out the stimulus package, the Federal Reserve in the U.S. has also basically signaled that they're going to do everything they can to keep things afloat. They want credit flowing through the system, the financial system. So they are there to backstop everything. And so the market knows there's support underneath. So there you go. We've got just basically the path of least resistance is higher. We've had the big down move, the big V-shaped recovery above the moving averages. So market looks good. I think we just going to keep going up. That's the Dow. Same thing for the S&P 500. It's hugging this line, moving up nicely, ready to tackle its all-time high back here that we hit in February. I can't see anything derailing that at the moment. And NASDAQ has just been strong. We'll look at the VIX in a second. NASDAQ just been strong. Had a little bit of a down move on Friday, and we may trickle back down to the 20-day moving average line for the NASDAQ. It's been very frothy. May have some profit taking here, but remember, it's been bouncing nicely off the 20-day moving average. So if it does come back down and meets the 20-day moving average, could be another good place to get long. Let's take a look at the VIX real quick. VIX is the fear indicator and the gauge of pricing in the options market. Volatility has a direct effect on option prices. So as volatility goes up, option prices get more expensive. As volatility comes down, option prices get cheap. I've been talking the last couple of weeks. Buying options when volatility is low is good. Selling options when volatility is high is good for option sellers. Right now, it is looking better for option buyers because option prices are cheaper on a dollar basis. So that's good for option buyers. It is also now below all of its moving averages, 20-day, 50-day, and 200-day. So this is really basically a reaction to the overall market. So as the overall market's going up, volatility is coming down. They move inverse to each other. So that's the way we're seeing it. Next week, same as it was before. Market looks strong. Can't see any reason why it would not keep going up. So stay long, stay strong, and use the pullbacks to the 20-day moving average as your first line of potential entry on bullish activity. Okay, so now let's talk about what we're options information for today. Now let's talk about a options position that we've taken in the past. We like to give out some free options information. We want to talk about one of our prior spreads that we've done, option spreads. One of the things we do at smartoptionseller.com is that we have a put option credit spread newsletter where we sell put options in uptrending markets to take advantage of that uptrending and decay in volatility. What does that mean? So what we do is we take expensive stocks, and since it's harder to trade those individually because the individual options are so expensive, we like to sell spreads, which means we will sell one option strike and buy another. And that creates a spread for us, and it allows us to take advantage of upwards movement in the market. So let's take a quick look at what we've done on a past trade using Netflix. So this is a daily chart of Netflix. We want to take advantage of an upward sloping stock, which obviously Netflix is. And it barely dipped down. I shouldn't say barely, but it didn't dip down too much in the coronavirus meltdown. And it had a quick little bounce, and then look where it's gone. All-time highs back here. It's had a nice pullback. So what did we do? Well, since Netflix is a very high-priced stock, in order for us to get involved in that trade, we want to sell spreads. And spreads, option spreads allows you to have a limited risk, limited reward type of trade. And how do we do that? Well, we sell a more expensive strike price, put option strike price, and we buy a cheaper put option strike price. Creates a spread between the two. So what did we do? Well, back on roughly around June 10th, which is right around here, Netflix was trading around $430 or so. We were using this is the 50-day moving average line right here. It had been bouncing off the 50-day moving average. So we got in right around here. And when you sell a put spread, that is a bullish strategy. So we want to sell puts or put spreads. That's how you take advantage of a bullish position, by selling naked puts or selling put spreads. We sold put spreads because it's such a high price stock. So right around here, around $430, bouncing off the 50-day moving average, we sell a put spread. And what that allows you to do is sell the spread at one price, and when the market moves up, that spread gets cheaper, and we can buy it back for a cheaper price. So let's take a look at what we did with Netflix. So at the time of the trade, Netflix on June 10th is when we entered the trade. Netflix stock was at $431 per share. So what did we do? we sold the August 21st, 2020, 300 put spread for 25 cents per spread. What does that mean? Well, it actually involves two separate transactions, but it's done in one spread trade. So we sold the $305 puts and bought the 300 puts as a spread. So we're selling one strike and buying the other. And we did it for a whole credit of 25 cents per spread. Now, what happens in this case is when you sell a spread or naked option as your initial trade, you sell to open, what you want to do is see that option price go down in value. So that means you can buy it back in the future to lock in the gains. This is different than the usual buy low, sell high. What we do is we sell high, then buy low in that order. That's exactly what you can do in the marketplace. So we actually sold this spread as our initiating or opening transaction for 25 cents per spread. And when the stock goes up in price, this 25 cents starts to tick down in value. That's what we want to happen. We sell it at a higher price and then we look to buy it back at a cheaper price. So what happened? Well, we actually ended up buying back the spread on July 13th for 3 cents per spread. That's where we get our profit of 22 cents per spread. We sold it initially for 25 cents and then we bought to close at 3 cents. We locked in a 22 cents per spread profit in 1 month's time. So in order to do this trade, you have to have a margin account at your brokerage, and you have to put up a little money called margin money to hold the trade. In this case, we were required to put up $475, or $475 of our free funds had to be held aside while this trade was active, and that's $475. And the way that you figure that out is the distance between the strike prices is $5. 305 minus 300 is $5, and you subtract out the spread amount that you took in. So $5 minus 25 cents is $4.75, and you have to times that by 100 because there's 100 shares in each option contract. So $475 is the amount of money you had to keep aside while this trade was active. That's called the margin requirement. You're not taking a loan from anybody. It's not buying on margin where you have to pay your broker interest. This is called a margin requirement. So to sell each one of these spreads, we had to put up $475, and 1 month later, the spread was bought back for 3 cents. So you made a profit of 22 cents per spread, or 22 actual dollars. And in order to figure out the return, you divide the profit of $22 divided by the margin requirement of $475 equals a 4.6 return on margin in 1 month's time. If you want to annualize that trade, it's a 55% return. Pretty good trade. So why did we decide to take that trade? Well, as I was looking at the Netflix stock chart, once again, we got in right around here, around June 10th. It's coming off support right on the 50-day moving average, and it was still going strong. It looked like it wanted to go up. So we got in here, sold a bullish put option credit spread, and as Netflix went up, 1 month later, in July, we unwound the spread for 3 cents. We bought it back for 3 cents. And that's pretty much it. That's how you initiate either a naked put sell or a put option credit spread. Both of them take advantage of upward moving markets. So that's it for today. Let's take a look at once again our website, smartoptionseller.com. You can go to the Put Selling Basics tab up here. Download your free copy of the Put Selling Basics ebook. Talks all about put selling. That's what we do here at Smart Option Seller. Once again, you can go to the Services tab. We have 2 newsletters, the Naked Put Option Selling newsletter, which is called Smart Option Seller, and the Vertical Spread Trader newsletter, which I just described on how we sell put option credit spreads. One-on-one coaching if you ever want some more hand-holding or more personal attention. We have our one-on-one coaching. So that's it for me today. Don't forget to like this YouTube video. Give me a thumbs up. Give me a comment. Email me, lee@smartoptionseller.com. I will always answer your emails. Tell me what you're thinking. And I want everyone to have a great weekend. Have a great week ahead. And this is Lee Lowell signing off.